This past year, we did 1.3 million in premiums for 24 clients for these two alternatives to CDs for better, higher yielding growth. The first is fixed indexed annuities. Now with this and the next one, we are going to note right away that these are a much safer institution than banks. If you would like to contest this point, what I would challenge you to do is look exactly where banks are keeping their money. That is in cash valued life insurance. They keep their serious liquid cash in insurance companies because they know that they are the backbone of America. Insurance companies aren't even legally allowed to be as risky as banks in terms of their loan to value ratios, usually way less, way more conservative. I know this isn't necessarily a big concern between banks and insurance companies, especially if you're below that FDIC insurance limit, but just something to consider without a doubt, the safer institution. Next is going to be better returns. CDs, very short term, can definitely have some appealing rates, but that's going to change with interest rates, and especially if you're someone who's going to buy a CD for 1 year and then buy another one after that, and then again and again and again, and continue to repeat that process. There's a reason that the longer you buy the CD, the lower the rate generally is. That's because there's going to be a lot of variance there. While there's still some variance with fixed index annuities and how they grow, there is complete downside protection, meaning if the market goes down, you're not going to lose anything to that, with some more upside potential. Not saying it's necessarily going to be astronomical, but in terms of returns over a 10-year span, definitely going to be the better on average in terms of returns. There's more flexibility long-term as well with fixed index annuities. The longer you hold them, you might put on some different riders. You might be able to turn this into guaranteed retirement income later on. So if you're putting money in CDs specifically to save for retirement to end up using it later, this could be something you start now, you defer it for 7, 10, maybe even 5 years or longer, and then start taking the guaranteed income then. And you don't even have to annuitize in a lot of these. That'd be a topic for another video, but taking money that's guaranteed, starting to build that foundation for it now, if that's a long-term goal of yours. A couple negatives here, they are less flexible short-term, so usually you aren't going to get a 1-year annuity or a 2-year annuity like you might with CDs. But again, if you're someone who ladders multiple CDs in a row, could be a better alternative. They're definitely more complex. The annuities are a lot more to learn, so I recommend watching much more videos if this is something of interest to you. And there is no FDIC insurance, meaning like the banks, they have that $250,000 that if they go under, you're still going to get that from the government. Insurance companies don't have that, but what I would challenge you to say is if this is really a concern that you have, you might want to reframe the way you're looking at it, just because look at the history of banks going under versus insurance companies. Look at the history of cross-insuring, other insurance companies coming in and picking up insurance companies that have gone under and taking care of those policyholders. Again, next to zero, but when you look at the Great Depression, 2008, thousands in the Great Depression, if not hundreds in 2008 of banks going under, next to no insurance companies. And the ones that do, like AIG, for example, generally were picked up and taken care of by other people. So again, if this is a concern, I challenge you to reconsider that being a concern. Second, the vehicle we're going to look at is cash value life insurance. This I alluded to a little bit before, and that is because, well, banks make their money, for example, by taking our money. We put money in our banks, and they take it, they invest it, they earn a rate of return, and therefore they're able to credit you the amount that, for example, they're going to credit you in a CD. So if they credit you 5% in a CD for 1 year, well, you can bet that's because they're taking your money and earning more than 5%. Otherwise, why would they do it? Now, the next thing we should do is look at where banks are putting their money to earn that rate of return to be able to credit us money, and where do we see them keeping their liquid cash? In cash value life insurance. Almost every big bank is doing this, around 5% of their entire holdings. But for the cash that needs to be liquid, that they need to access, they want growing, hitting singles, keeping it completely tax-free, where do they keep it? Cash value life insurance. Reason is safety, number one, far better returns as well over the long haul, especially when you consider in the fact that they are tax-free, and there's going to be way more flexibility long-term in terms of accessing the money, getting an arbitrage, maybe even on that money. Again, some topics for another video, but generally something that you're going to lock into longer term. That's why I said more flexibility long term. Short term though, so if you're someone who just needs a 1-year CD or a 2-year CD and you're gonna be done with them, it's hard for either of these vehicles to really compete. But if you're someone who's laddering them, that's where they come in. So that's why I said not a short-term solution here. They really require patience. Those are kind of the same, but the reason is because with these specific policies, there's early year fees that are front-loaded just like the interest on a mortgage. So if you're paying off a mortgage, those early years you might be paying down the interest, you're not really even hitting the principal. Kind of same deal with this, where there's those early year fees, and it takes a while to really reap the benefits of the cash value life insurance policies. So again, this is a CD alternative, but it's more so a CD ladder strategy alternative, meaning you're going to buy CD after CD after CD and keep doing that. In terms of a 1 to 2 year alternative, technically this one isn't. And then lastly, these two as well take more understandings of the product. Both of these I think are great alternatives, but I encourage you, if you are wanting to learn more, to educate yourself first. I do that 5 times a week on this channel. Subscribe, and I will see you in one of those videos.